Chapter 2: Forward, Futures, and Hedging. Here's the outline for Chapter 2. First, we will introduce the forward and futures contracts. These contracts are effective tools for hedging risks involving the underlying assets in daily financial practices. We will then demonstrate how they are used for hedging. We will also study the minimum variance hedge, which is the most popular hedging strategy in practice, as it is easy to implement. We will emphasize hedging using stock index futures in the last section for its crucial role in equity portfolio management. Now let's start with the forward contracts. A forward contract is a customized contract between two parties to buy or sell a specified amount of an asset at a specified price on a specified future date. It is a legal document that binds both the buyer and the seller of the asset to a specified future transaction. Although the underlying asset is a priced commodity, such as sugar, oil, etc., it is considered as a financial asset. Because the contract has an intrinsic value determined by the market prices of the underlying asset. Furthermore, the underlying assets are not limited to physical commodities. They can be, for instance, foreign currencies or interest rates as well. Forward contracts can be used for hedging or speculation, the non-standardized nature of which makes it particularly apt for hedging. Having introduced the concept of forward contracts, it is also worth mentioning that the market for trades in contracts for future delivery of the asset is called the forward market, whereas the open market for immediately delivery of the asset is called the spot market. Throughout the module, we will use the capital letter F to denote the forward price, which is the price that applies at delivery. The value of a forward contract, denoted by the small letter f, is 0 when the contract is initiated, but will vary during the course due to the fluctuation of the spot market price. Now let's take a look at an example on a Treasury bill forward. Here is the scenario. An investor with some cash to spare in 3 months' time would thus like to arrange a loan starting 3 months from now, assuming that the cash would be available for 6 months. What he needs to do is to obtain a Treasury bill forward contract with a bank to deliver to him a 6-month T-bill 3 months from now. The forward price is agreed upon today such that he does not need to pay anything for entering the contract. This price can be determined by the 6-month forward rate, beginning 3 months from now. Assume the face value of the T-bill is $1,000 and the forward rate is 10% per annum with semi-annual compounding. Then the 6-month forward rate is 5% and the forward price can be calculated by $1,000 divided by 1.05, which is equal to $952.38. To better understand the implementation, let's draw a timeline. At the current time spot, the investor signs the forward contract to buy a 6-month T-bill at $952.38 3 months later. The T-bill has face value $1,000 and lasts for 6 months. That is to say, after 9 months from now, he will receive the $1,000 for repayment. Now let's give a formal analysis of the forward price formula. And for the time being, we have the following assumptions. The underlying asset of the forward contract earns no income, does not have storage cost, and can be sold short. With these assumptions, it is natural to expect that the theoretical forward price at time 0 for delivery at a future time capital T, denoted by capital F0, is the projected future value of cash of the amount that equals to the current spot price of the underlying asset, denoted by S0. Let D0T be the discount factor between time 0 and time capital T. Then we have the following formula. F0 equal to S0 divided by D0T. This formula can be proved by the no arbitrage principle. More precisely, if the equation does not hold, then there exists arbitrage opportunities. Recall that the strategy to construct an arbitrage is to buy the undervalued assets and sell the overvalued assets. Now let's consider two cases. First, if F0 is strictly greater than S0 divided by the discount factor. Clearly, the forward contract is overpriced and the underlying asset S is underpriced. Thus, we will enter into a short position in the forward contract and long 1 unit of the underlying asset. That is, borrow S0 amount of cash to buy 1 unit of the underlying asset on the spot market. On the delivery date, we will deliver the asset to the buyer of the forward contract and receive F0 amount of cash. The loan will then grow to S0 divided by the discount factor. After paying back the loan, we still have net profit F0 minus S0 divided by the discount factor, which is positive based on our assumption. For the second case, if F0 is strictly less than S0 divided by the discount factor, just reverse the previous strategy. That is, short the overpriced asset and long the underpriced forward contract. Since both cases lead to an arbitrage opportunity, equality must hold. Here are some remarks related to the trading strategies introduced in the previous proof. A transaction in which one buys the underlying asset and takes up the short position in the forward contract is called a cash and carry. Obviously, such a transaction bears no risk, because the long position of the asset covers the later obligation to deliver the underlying asset under the forward. Therefore, the arbitrage strategy used in the proof for the case when F0 greater than S0 divided by the discount factor is called a cash and carry arbitrage. And that used for proving the reverse case is called the reverse cash and carry arbitrage. Now let's take a look at the following example of a forward contract on copper. The current spot price of the copper is 84.94 cents per pound. Given the 9-month T-bill price, can you suggest an appropriate forward price of copper for delivery in 9 months? The 9-month T-bill with face value $1,000 sells at $970.87. Implies the discount factor for 9 months is 0.97087. By the forward price formula, we have the 9 months forward price of copper is 87.49 cents per pound. In this example, we simply ignored the storage costs of the copper, which is in fact non-negligible. We will take this into consideration in the next lesson.